We talked about what is asset protection. The next question is, what risks are we protecting ourselves from? And I've divided the universe of risks into four major categories. We have physical risks. People don't really like talking about physical risks, but I would say that in the back of your mind, it plays a big role in much of what you do, where you live, where you go to, where you send your children to school, where you work, even where we are here in this hotel, right? There's some places that you want to be, and there's some places that you don't want to be, and physical risks play a role in that. Next, we have economic risks. Now, I'm the first one to tell you. People always ask me, Joel, what should I invest in? And I say, I don't know. That's not my thing. I'm not an investment advisor. I'm not telling you invest in this stock or this bond or this mutual fund. But if you want to look at a bigger picture from an economic perspective, what we see is that all paper currencies, as Voltaire said 200 years ago, will eventually reach their intrinsic value, and that value is zero. So we have paper currencies going down. They're all going down at different rates. Sometimes one accelerates downward, which makes other currencies look like they're going up, right? You see in the paper, the dollar's up against the euro, the dollar's up against the Swiss franc, the yen's. No, all currencies are actually going down. And, if I need to prove that point, and I'm not a gold bug, but I think that everybody in this room will at least acknowledge that gold is not something that governments can create, right? There's a very long, hard, expensive process to mine gold and make gold bars. And so you've got gold bars. If we go back 100 years in time, a 1 ounce gold coin cost about $20. Okay? If we measure not how much gold has gone up, but rather how much currencies have gone down against gold, every currency, if it's still in existence, and a vast number of currencies from 100 years ago aren't in existence anymore. No such thing as the Reichsmark, for example. But if you measure with gold being the yardstick, every currency in existence from 100 years ago has gone down between 91 and 99%. So, there's not that much more to go. If I think about my own, more recent history, going back, say, 30 years as a student, I had an opportunity to study in Germany and Switzerland, and I remember going with some of my friends to a little Italian pizzeria, and I could get a beer and a pizza for 10 Swiss francs. Okay? Remember that vividly. I didn't always have 10 Swiss francs, but 10 Swiss francs then was the equivalent of $2 because it was 10 Swiss francs to the dollar. Now, if we could forget about inflation and all those things, let's imagine that we could go back and find the same pizzeria, and I could get the same pizza and the same beer, and it still cost 10 Swiss francs, meaning no price change. Probably wouldn't be the case, but let's just assume that we could do that. Would that still be $2? Well, no, because in the last 30 years, the dollar-Swiss franc ratio has gone from 5 to 1 to 4 to 1 to 3 to 1 to 2 to 1 to 1 to 1, and now it's inverse. So it's about $1.05, $1.10 to get a Swiss franc. So that means that same 10 Swiss franc pizza would now cost me between $10 and $11, right? That's the case of the dollar falling faster than the Swiss franc, even though the Swiss franc has also gone down in value. So the only reason I mention economic risks, and frequently I'll ask clients, tell me in which currencies your assets are denominated. And they look at me like I'm a Martian with, horns and antennae coming out of my head, right? And after they understand the question, it's like, well, dollars, of course. That's what we have. We have dollars. Sure, we earn dollars, we spend dollars, but from an economic risk perspective, we should be thinking about real diversification. There's lots of ways you can get that from an investment standpoint, whether it's precious metals, real estate, or other currencies. So I just mentioned economic risks here because if we have all of our proverbial eggs in one basket, and our U.S. dollar portfolio goes up, but at the same time it's going up, the dollar is becoming worth less and may eventually become worthless, we're not really doing anything to protect and preserve our wealth over generations. And that's one thing I see when I do work for like family offices and very wealthy individuals, is they're very concerned about these long-term trends, and they want to make sure that no matter what happens with the dollar, the euro, I think The Economist had an article a while back, and they were comparing the dollar, the euro, and the yen. And they said, well, the dollar's an IOU, and the euro's a who owes you, right? Because you don't really know. And they finally said that it was like a beauty contest between the three ugliest women in the world. Sorry, don't mean for that in any way sound sexist, but that was The Economist comparing the dollar, the euro, and the yen. So we live in a world where the governments are going to keep printing, and we all inherently know that if you print more of something over time, it will become worth less, and then eventually, like Voltaire said, become worthless. So when you're doing long-term asset protection planning, think about real economic risks. Everybody's different. If you come to me and say, hey, I've got 10% of my money in gold or 10% in real estate or whatever, at least you're thinking about this issue, which is better than most people, because most people don't. And of course, a U.S. brokerage firm or broker-dealer or investment advisor, they're never going to tell you to diversify, in that sense. All right. Then we have taxation risks. And, everybody hates taxes, but that's the two truths in life, death and taxes. There are certainly things that we can do to legally minimize, defer taxes. Somebody once asked Albert Einstein, what's the strongest force in the universe? And his response was compound interest, right? We know inherently that if something can grow in a tax-deferred way, whether it's an IRA, a SAR-SEP KEO, 401k, life insurance, there are lots of legal ways that money can grow on a legally tax-deferred basis. And if we can accomplish that in an offshore environment, sometimes we can get a lot of real benefit for doing that. But again, there's no magic fairy dust. Sometimes you hear some speakers, they say, put your money offshore, invest in this, and you'll never pay tax again. And I would say run for the hills when you hear that, because it's almost impossible to accomplish that in this day and age. Then we have litigation risks. Taxation we all hate, right? That's what the government does to us. Litigation is what we do to each other. And the U.S. is the most litigious country in the world. About every 17 seconds, a new federal lawsuit's filed. The nuisance value of the federal lawsuits is approaching $50,000, which means that, we're all paying the cost of these lawsuits, in higher consumer products, higher health care, higher this, higher that. We had this tremendous debate about, Obamacare, where you come down on, national health care, doesn't really matter. But if the truth were actually told that something like 52 cents on the dollar of each healthcare dollar is due to litigation costs, I think we would be having a much different debate. And of course, the trial lawyers, which are big lobbyists themselves, don't really want that issue to be front and center. Most people, they tell me, wow, I'm really surprised. I had no idea, right? That 52 cents of every healthcare dollar are for legal litigation costs. If you add in state and local, it drops to about every 7 seconds. Every 7 seconds of every minute, every hour, every day, a new lawsuit. So we know that the playing field is not level. We don't live in a country that has a level playing field. We live in a country that's very pro-plaintiff, meaning the system is designed to reward plaintiffs lawyers. Insurances are quick to step in and settle, which again drives the costs up. There are countries in the world that do have what I would call a level playing field. The UK would be a good example in my mind. In the UK, anybody can bring a lawsuit just like they can in the United States, but there are some distinctions. One, they have a very long tradition of what's called the loser pays, right? So if you sue me and I defend myself and I win, then you're going to have to cover the costs of that litigation. And what I think is also very interesting is that if the plaintiff is indigent and can't pay the costs of the defendant who wins, then that legal financial obligation is incurred by the plaintiff's lawyer. Now, do you think that might make lawyers a little bit more picky about the kind of cases that they take, so you don't have this litigation mills just cranking out demand letters every day trying to intimidate defendants and insurance companies into making settlement payments? But as an asset protection lawyer, I'm not really looking to try to find a level playing field, right? That it's better than what we have in the U.S., but my goal is to help find the jurisdictions that have the best asset protection, which means that the playing field is tilted the opposite direction.